And hello to everyone, all participants in this conference. In this presentation, I aim to provide an overview of the different approaches that pension funds and other institutional investors can choose to measure the degree of climate risk in their investment portfolio. And I'm very grateful to Laura Starks for introducing the importance, the topic of climate risk for pension funds in particular. The title of my presentation says Dutch pension funds, but I think that my findings are potentially of interest to a much broader group of investors. So I chose a different graphic than Laura to illustrate the problem. These are the well-known warming stripes with different countries on the horizontal axis and a time scale on the vertical axis, basically showing that climate change, global warming is real and is likely to go to affect societies at large going forward. And of course, we have already seen some signs of it. The particular reason to talk about climate change in this presentation is that climate change is also likely to be an important form of financial risk for especially long-term investors such as pension funds. Why is that the case? Well, Laura already talked about this quite a bit, but usually a distinction is made between two types of risks that pension funds might run due to climate change. The first one is physical risk. This is referring to the damage or loss of assets, usually as a result of extreme climatic events such as floods, storms and wildfires, but also more slowly developing processes like droughts. And of course, these losses or damages can occur anywhere in the supply chain, thereby affecting the valuation, profitability of firms, thereby affecting the investment portfolios of long-term investors. The second type of risk that is often talked about is transition risk. Hopefully, to mitigate the consequences of climate change, governments and other international bodies will become more and more active in implementing regulation to reduce carbon emissions in the economy, for example, by introducing a carbon tax. And if companies need to pay a carbon tax, their profitability is going to be hurt. That's again a form of risk for institutional investors. On top of this type of regulatory risk, we can also think about technological risk, legal reputation risk, and all of these types of transition risks could result in the stranded assets that Laura also talked about. So arguably, climate risk is indeed a very important form of financial risk already. And Laura already talked about her own survey in which she indicates that 50% of global institutional investors feel that regulatory risks in the area of climate change have already begun to materialize. So pension funds in particular should have a great interest in trying to measure, trying to assess the degree of climate risk in their investment portfolio. But this is a very hard thing to do because this is a long-term systematic risk. The consequences of climate change will probably take place over a period of decades. It's probably going to affect many firms throughout the economy, so that makes it hard to diversify and hedge, and it's also very difficult to measure. It's, in a sense, a new type of risk. There's huge uncertainty about what it really entails. You could even call it Nietzschean uncertainty. The common approach that investors use to measure risks is basically analyzing historical data, but because likely most of the effects of climate change have not been observed in the recent past yet, historical data are likely of little use. And then also these different forms of risk, physical and transition risk, could interact in a myriad of ways. For pension funds in particular, and in particular in Europe, it's really important to start measuring climate risk right now, if only as a result of the new IORP2 regulations that say that pension funds need to include climate risk in their own risk assessment. So what I did in the underlying study for this presentation, which I carried out for a mid-sized Dutch pension fund, is I tried to make an inventory of available approaches out there, taken from the academic literature, also taken from policy institutions, but also from commercial providers, consultancies, to measure such climate risks. And I distinguish between four broad categories of such risks, which I discuss in my study. And what I will do next is go one by one through these approaches explain briefly what they entail, and then also what, in my view, are the main pros and cons. So the first type of approach is what I call top-down or macro level approaches. Second type, sector level approaches or meso approaches. Third time, bottom-up micro approaches. And the fourth approach that I distinguish is a factor model. And the first three of these approaches rely on scenario analysis as one particularly helpful way, in my view, to deal with the types of uncertainty that we talk about when we discuss climate change. And those are similar analysis to the asset liability management studies that many of you are familiar with. So let's start with the top-down approach. What happens in these approaches? Well, by and large, what happens is that climate change scenarios are incorporated into usually very large, very sophisticated macroeconometric models. These models are subsequently used to come up with predictions for key economic variables such as growth, inflation, interest rates, and subsequently, usually an additional model is used to translate these economic consequences of these scenarios into consequences for the investment portfolios of pension funds. Often this is done by sector and country, sometimes this is done in an ALM framework, and this can be done for both physical and or transition risk. So the appeal of such an analysis is obviously that climate risk is a macro phenomenon, so to speak. So the consequences of climate risk are going to be very wide-ranging. We expect, so this really asks, so to speak, for a macro type of analysis. Moreover, such an analysis can account for feedback effect. For example, in the financial sector, if one financial institution is affected, then through interlinkages between different financial institutions, there might be indirect contagion effects on other financial institutions, and a macro analysis has the possibility to capture it. In terms of cons, I think the main disadvantage of this approach is that it's essentially a black box approach. I do not mean to say that these approaches are not transparent, because usually these models are published, so you can actually see all the dozens and sometimes even hundreds of econometric equations, so you know what the model looks like. But what I mean to say here is it is very hard to understand how the different forms of climate risk play out, what's really going on. So these models are very complex and therefore also intractable. Moreover, in ALM type studies, the interest rate prediction is going to be very, very important. And there's also a lot of uncertainty about what climate change might do to interest rates. On the one hand, you could say, well, maybe people are going to save a lot for precautionary motives, and therefore the interest rate might be depressed going forward. On the other hand, a lot of people argue that the transition to a low carbon economy will require huge investments, and therefore maybe interest rates go up. So we don't really know, but this is going to drive the results to a large extent. And then we have the well-known Lucas critique. Basically, these models are a description of the current state of the economy, and we're going to use those models to analyze what happens if the state of the economy is going to change very significantly, potentially because of climate change. And Lucas has pointed out that this is a very tricky thing to do. So although I see the appeal, I'm by and large quite critical of the actual merit in practice of these top-down approaches. So what do I mean with sector level approaches? Well, these approaches, I've seen a variety so far, usually have some kind of analysis of the impact of, so far in particular, transition risk on specific sectors. So rather than having a very complex model, it's almost like a back of the envelope style analysis of what, for example, a carbon tax would do to the profitability in a certain sector, depending on the type of sector and depending on how that sector might be responding to that. So it's far less sophisticated, but therefore also more transparent or more tractable. There are usually no macro predictions on economic growth as a whole in these types of approaches. So that's, of course, the big disadvantage. So let's start with the advantage. It's a broader analysis than at the individual firm level. It's more practical, and in my personal view, it facilitates an informed discussion because different people might disagree on how susceptible different sectors are to these types of risk. But you can talk about it because there's no complex model, but it's a relatively straightforward economic reasoning. The con is that it's not a macro analysis, and that's ideally what you would want. Then there's a number of important assumptions that you would need to make within this approach. One is, of course, the sector classification. There's a lot of debate about that going on, also in light of the EU taxonomy that has been developed. Then it's important to say something about the so-called pass-through within different sectors or industry. That is the ability of firms in that industry to pass through any carbon tax, for example, to their customers, depending on their competitive environment. And then the third type of assumption that is needed is the so-called abatement assumption. In some sectors, it might be easier to adjust, for example, your production processes and thereby avoid a carbon tax. In other sectors, it's likely to be more difficult, and we don't really know. So you need to have some kind of discussion about it. And I think that these approaches are in a relatively early stage so far, so we do need extensions, for example, distinguishing different regions and physical risk. But I do see at least some merit in the type of approach here. Then we have the bottom-up approaches. This is, I guess, the approach that is most often used so far. This is also one of the results of Laura Starks' survey, that actually what a lot of investors do, they gather firm-level data on climate risk. For physical risk, that's often the geographic location of the businesses that the firm owns, and then information on, for example, the climate risk, floods, droughts, of that geographic location. For transition risk, what you see a lot is that firms try to measure the impact of an individual firm on climate, for example, through the carbon footprint and or actual firm's climate policy. And then what you see a lot is that these firm level data points are aggregated to the portfolio level. And then, for example, you get the carbon footprint of the entire portfolio as a proxy for how much climate risk you are running. So the pro is that this is really a detailed firm level analysis. So you're actually looking what is in my portfolio and how much risk might those assets have. In principle, there's no automatic aggregation by sector or region, and it's also very practical because you can really understand what is going on. The count is, of course, that it's not a broader analysis, it's really a firm level, so we don't have any idea about how this is going to play out at the macro level. The data quality is particularly important for this type of analysis. And if you really only aggregate to the entire investment portfolio, I'm arguing in my study that you're losing a lot of information and it becomes like an automatic large data exercise, and that might also not be so informative. The final category that I talk about in my study is really stemming from the academic literature. Those are the factor model approaches, and basically they build on the idea within the asset pricing literature that you could measure the exposure to different types of risk using the beta, the risk loading, with respect to different factors. So if you have a factor that potentially captures this type of climate risk, and in the literature we see factors related to temperature, to droughts, and the so-called brown minus green factor, then in principle just one beta with respect to that factor, if it's only one factor, could measure the climate risk of your entire investment portfolio. And that is 2 minutes?
Yep.
Sure. That is very appealing, obviously, because then you have just one number that measures the whole thing. And in principle, it's easy to implement. However, at this point, I believe it's too early to use these types of approaches. There's no consensus really on the risk factors. And a big downside is that this approach is really purely based on historical data. And I've just argued that that might not fly for climate risk. One more slide about the data quality, especially relevant for the bottom-up approaches, and then I'll wrap up. So I think there are three main issues. I will not elaborate too much. The first one is limited coverage and data quality. Think about the ESG data, usually only publicly listed companies, no international standards. Then recent research indicates that there's actually quite a bit of disagreement across the data providers with low correlations. And then it's not so clear what to measure, or maybe it's clear what you would want to measure, but not so easy to actually measure that. For example, for physical risk, you might have the geographic location, but you still don't know how easy firms can adjust their projection processes. For transition risk, carbon footprint, very interesting. You probably want to know that, says little about whether firms are able and willing to actually reduce their carbon footprint going further. So I think you need more forward-looking measures. So summing up, I think that bottom-up approaches are almost inevitable because that's really what you want to do. That really says something about your portfolio, but they depend on data quality, are limited in scope, and may result in these large data-driven exercises. So my recommendation to pension funds is to complement this bottom-up approach with sector-level approaches. I'm personally quite skeptical about the top-down macro approaches. And of course, and that goes for many things, but especially for climate risk, I think it's crucial to remain critical and skeptical and not trust a single approach or model because all of them have serious limitations. Let me stop here. Thank you very much.